Hi, this is Mani from bsc to nse.com. So in this video I'm going to cover or talk about trading psychology and how to become a better trader. So basically I've made videos on various other topics like technical indicators and how to use them and all. But then one should remember that every trader out there has access to all these information, all these technical indicators, news. Of course, news some people have sooner access, but then otherwise everyone has access to all these indicators and the softwares and signals and all. So, how do actually some traders become successful and then the others still continue to lose? So that's where the trading psychology and certain aspects on how you are going to think, how you are going to use these indicators matter. So I hope some of the points that are covered in this video will help you out. And for a free training from bsc to nse.com, check out our website. Before we proceed to the other slides, so let's get to the first point on trading psychology. So again, these are all points that are my opinions, so you can have your own over a period of time. You may find that what would have helped you redefine or become a better trader. So for me, these points have helped me out personally, and I'm going to share that. So keeping your trading capital small. So you always have to be in a position wherein the trading capital can vanish overnight, and you need to remember that even though you try to put in all the risk management, you should try to understand that trading can go wrong pretty bad. So try and keep your trading capital small, and if you make a really good kill, let the small capital become a really big capital, or let the profits make profits, and let the profits be reinvested and continue to make more capital over a period of time by raising the profits. And so the point is, if you keep your trading capital small, even if it vanishes out, you can bring back capital again and get back into the trading game. And again, the longer you stay in the markets, the stronger you get and the smarter you get. So one of the other ways of achieving this is to allocate 90% in long-term equity. Now again, I believe to be a successful investor, successful trader, you should also be a successful investor to understand the overall perspective of the markets. Because a trader, a pure trader, will only have will only develop the trading instincts. He'll forget the methodologies that an investor will use, and which can go against a trader at times. Not all the time, but then and you should remember that traders mostly try to follow the investor sentiments and make money. Traders are mostly small time traders, and they try to follow the sentiments of the big time investors who decide the market moves. So being a long term investor yourself helps a lot. And when you allocate 90% in long term equity, so if the trading capital gets hammered a lot, you'll be able to bring in cash very easily by even squaring off a small amount in equity. And the other way it helps is when your long-term portfolio does well. So that's a totally different topic, how to be successful as a long-term investor. So that again comes with practice and a lot of time spent in the markets. So once you do well with your long-term equity, you'll see that your net asset invested in the stock market goes up, irrespective of whether you do well or not in trading. So that takes a lot of pressure out of the trading that you do. So you don't worry too much about not making money in your trades. So when there is no pressure, you automatically tend to do better in trading. So let's move to the next point. So the next point is something like a radical point. Focus on avoiding a big loss, never focus on making profits. So a lot of people tend to think like, if I enter into this trade and if the share price goes up like this, then I'll make a huge profit. And then they forget about the loss making zone. So if you focus too much on profits, or if you focus only on the part that the markets are going to move in your direction, then you're not giving enough attention to the other side movement, and you tend to forget about the risk management. When you get too overconfident looking at a technical indicator or a candlestick pattern or any particular kind of data or news, you tend to think that market's going to go one way alone, and then you are only thinking about the profits that can be made out of the trade. So you forget about covering for risk management and all that. So a very strong or a very good trader will always focus on avoiding a big loss. Even before entering a trade, you'll plan for what will I do if it goes the other way. So how am I going to restrict the losses if in case the markets jumps the other way. So you're always going to you're always going to focus on avoiding a big loss. As long as you focus on avoiding a big loss, a big profit will come to every trader that is there in the market, and luck will favor everybody equally, and it doesn't have any bias towards anyone. So I believe everybody makes a good profit once in a while. So the good trader will avoid a big loss. So that's where which will eventually decide whether you make profits or not at the end of the year after you spent in the markets for 12 months. Whether you end up with net profits or not depends on avoiding a big loss. So if you avoid a big loss and you're just making small losses, small profits, and then a big profit is going to come your way. So focus on avoiding a big loss. Never focus on how much profits you're going to make out of the trade. So if somebody is giving you a call or a tip, then the first thing you ought to look at is what is the maximum losses I'm going to make on this trade, and how can I restrict that loss. So that should be the angle of thinking, and once you start thinking that way, you will start getting better at risk management. Okay, so I hope I have made my point here. Let me move on. The next thing is to introspect into your own trades, and every trader has a trader's instinct. So again, like I said, there'll be some traders who will be good at trading stocks, some will be good at trading the index, some will be good at doing in options, some will be good at in futures, some may be good at equity intraday trades. So while whatever you're trading, try and introspect into your trades, like what kind of trades ends up in constantly in losses. Maybe you're good trading in Nifty, so you should stick to only Nifty and not deviate into stocks which may constantly be giving you losses. And similarly, every trader has an instinct. So before you enter a trade, something will tell you that maybe this trade is anyway gonna get into a loss, but you still enter the trade. So think about your instinct and how good you feel about the trade before entering the trade. If you're not feeling too comfortable about a trade, then you should probably not trade it. So just introspect into your own trades and your own instinctive feelings. Try and work your way inside and see if there's any help there. This is a very subjective topic, so I'll leave it at that. And moving on, you should stop after making a loss-making trade, especially intraday or even positional trading. After making a loss, if it's a positional trade and you made a loss, take a break for a week, a weekend, and sleep overnight will make you forget about the loss, and the revenge or vengeful kind of thinking will go out of your system. And especially in a day where you made a loss, don't definitely enter a trade on the same day for sure. If you're an intraday trader, you made a loss, you can do 5 trades in a day as long as you constantly make profits on all 5 trades. So after making 2 profitable trades, on the third trade, if you're making a loss, end the day, stop for the day, and then you can sleep, come back again tomorrow. So a lot of people will lose 1,000 rupees on the first trade, and then will want to recover that back on the same day. They'll enter a next trade and then they lose 5,000 or 10,000. Okay, so that's how bad it goes. So for personally, I find that including this decision into my trading has brought a lot of good. So if you make a loss, stop for the day for sure. If it's a positional trader, stop for a week maybe, and then just watch the markets for a while and then get back in when there's a really good opportunity. Moving on, the next point is reducing the frequency of trading. Now, the previous point of taking a break after a loss will also help you reduce the frequency of trading. So, you shouldn't we shouldn't jump from one trade to another without even thinking about or looking at the chart or looking at your own logic for entering into a trade. So, a lot of people have the habit of just jumping from one trade to another in a lot of rush and thinking that the money should not sit idle in my trading account. So, that also has to be stopped. So, the other general point is you should watch more and trade less, meaning look at the charts, look at the technical indicators and whatever you're following, watch more of that before entering a trade. Now, after you enter a trade, if you're just looking at your positions, staring at the desktop, hoping for a profitable trade, then that's not watching more. Okay, so you should watch more when you're not in a trade, and once you enter a trade, just stick to your trade plan, and then the execution should be less, and the number of trades you enter should ideally be less. So try and watch more and trade less. Okay, moving on. The other thing that just worked for me, it may not work for you. So stick to Nifty or the index-based trades mostly, or if it's again if that's working out for you, within the trading capital, allocate a large amount to Nifty-based trades. And again, for me, instead of the current expiry Nifty, in Nifty we have expiries for even up to 12 months, 15 months ahead at specific strike prices. Those seem to be working very well for me of late. So maybe I should do more of that and less of the current month expiries. So I mean, stick to the trades which are giving you profits, even if it's less, and it has to be consistent. So stick to Nifty. Nifty is probably the least destructive. Stocks can be very violent in their movements overnight. It can open huge gap up and gap down. On the one side, again, like I said, don't think about only the profits. Worry about avoiding a big loss. So in that case, sticking to Nifty makes sense because you're probably not going to make a huge loss overnight. Huge loss overnight, and trade very less on stocks. So when you maybe in options, specific strategies like during earning season, you can go for a hedge, but otherwise stick to Nifty mostly, especially as a beginner in the initial years. And moving on to the next point, less is more with consistency, and this is what I tell a lot of people, that 5% a month every month for the next 40 years is the path to the richest person in the world. 1 lakh in Indian rupees will become something like 14 lakh crores in 40 years if you achieve 5% a month, and that's the richest person in the world. That's becoming the richest person in the world, or entering the Forbes top 10 richest people. So understand that 5% a month is too good actually, and it's the path to the richest person in the world. So try and understand that not too many people have done it. In fact, 1 in a billion do it. So try and have less expectations from the market, because a lot of people go after like 30% profitable trades in options or futures in a very short time. So try and understand that we are being extremely greedy, that the system cannot yield such returns consistently. So while yes, we have to take those kind of bets, you remember that you've done a really good trade. Any trade which is profitable is really good, and just avoid a big loss like I said before, and understand that less is more in the long run if you do it consistently. And then the other thing that I keep in mind is, if you lost 10,000 rupees in a trade, if you had invested in long-term equity and achieved 30% annual returns over 40 years, 10,000 rupees can become 36 crores. So a loss-making trade which you made because of weakness in psychology, because of your trading weakness, is like wasting 36 crores 40 years down the lane. So I keep telling myself this whenever I lose anything more than 5,000 or 10,000, that I wasted 36 crores 40 years down the lane, which I could have invested in long-term equity. And of course, 30% annual returns is very much debatable, that you need to be a really extremely good long-term investor to be able to do that. Now, if you're gonna claim that that's impossible, then we should also agree that in trading, that people expecting 10% a month is literally impossible. So try and understand all these aspects, and that kind of helps you out. And that's it. I think may have some more, but that's it for today. And you can share and share your feedback with us. Subscribe to our YouTube channel and stay in touch. And that's it for now. Thank you. Bye bye.